Hi there, welcome to Neppy in there. It's a very special episode I have today as I'll be featuring two special guest stars. But before I get to that, today I'm just going to be talking about three ASX stocks that some investors would classify as being dog stocks. And I'm going to raise the question, should we be giving these companies another chance? So let's get stuck into it with the first special guest. And the first guest star is Nala. So today, the three companies I'll be focusing on are AMP, AGL, and Boart Longyear. Now, the three common themes with these companies, apart from many investors consider these companies being dog stocks, are they are a very old companies. AGL was formed in 1837, AMP in 1849, and Boart Longyear in 1890. And there is actually a strong possibility that at least two of these companies won't be in existence by the year 2025. And here is Milo bringing you AMP. Now, this company formed in 1849 as Australian Mutual Provident Society, and they remained in that sort of form for 150 years before they decided to demutualise in 1998, and they listed on the ASX on the 15th of June in that year. And I remember that time of my life fairly well because that's the day after my birthday, and I was working as a camp counsellor in Massachusetts, probably pretty unsuccessfully doing that. Now, 1.3 million Australians got shares in AMP when they listed on the ASX, and hopefully most of those shareholders have sold out, because if they held on, they would have seen their value of in AMP severely being dented, because the share price has gone from $14 all the way to $1.42. So this is the reverse of a 10-bagger, sort of a 1/10 bagger, and that's not the sort of company you're to be holding in the long term. So this is definitely not the buy and hold sort of company. We have seen some short or medium term uptrends. You can see between about 2003 and 2007, the share price went from $3 to $8 or $10. But otherwise, the share price has been in a long-term downtrend. And there are questions about the long-term viability of this company. They have sold some parts of the business, and they were recently possibly going to be bought out by another company, but that fell through. So I think within 5 years, this company will no longer be in existence. That's just my opinion at this point in time. Say goodbye, Milo. Bye. Now on to AGL. Now, with AMP, I have no intention in buying this company. So AGL is a little bit different, because I do think there is potential this could be a turnaround play eventually, maybe the next few years, because the share price right now is at its all-time low. Now, this company was formed in 1837 as Australian Gas Light Company. So the gas refers to them selling gas for people to light their homes, maybe for towns to light their streets, that sort of thing. They have evolved with time and have become a sort of energy provider for lots of households. So the share price, they listed in 2006, October that year, and the share price from when they listed all the way to 2015, it was just no growth in the share price at all. More than likely, they provided a nice dividend yield for their shareholders, but that was no capital gains at all. But starting in 2015, for about 2 years, the share price did double in share price from $14 to $28. So that's a nice little uptrend. But when it reached its peak of $28 in 2017, at the start of that year, the share price has been in well-defined downtrend. And when we get to the next slide, you'll see that it's a well-defined downtrend pretty well. And actually, the downtrend has accelerated during 2020. So this is the weekly chart for the last 4 years, and you can see the well-defined downtrend here. We have 4 peaks in the share price, and those 4 peaks align perfectly with the downtrend. However, in 2020, that downtrend has accelerated, and even with the next slide, you're able to see that acceleration in the downtrend very well. This is the daily chart for the last year, and I've kept that long-term downtrend on there, and I've just put in now the short-term downtrend, which is share price accelerating along that short-term downtrend. And what I'm waiting for is any sort of sign that that short-term downtrend is coming to an end. But even if it does come to an end, we still have the long-term downtrend to contend with. So we might see recovery in the share price from like $9.42, which it is now, back up to the long-term downtrend, which is about $18, and then it might fall off again. Who knows? So keeping my eye on AGL for a possible turnaround story in the future. Now to a very weird looking chart, and this is Boart Longyear. Now, if you go back to 2007 and 8, and if you look at that chart, if you believe this chart, you would think that the share price of this company was $5,000 or $6,000 back then, but it wasn't. And the reason why it wasn't is the fact that they've done numerous recapitalizations and capital raisings, which have increased the shares on issue, well, did increase the shares on issue to over 26 billion. And no management group of any company wants that amount of shares on their books. So in November 2019, management decided to do a 300-to-1 share consolidation, which vastly decreased the shares from 26 billion to about 87 million or so. So if you own, say, 3,000 shares, all of a sudden you only had 10 shares, and that means, in effect, your value of your shares has significantly decreased in value since 2006 and 7. So hopefully you have not been a shareholder since then, because your value of your Boart Longyear shares has probably diminished to almost nothing. Now, something else you have to take into consideration when you're thinking about Boart Longyear is the amount of debt they still have on their books. Most recently, the market cap was only 56 million, which you might think fairly cheap because they have something like $1 billion in revenue. They are operational cash flow positive, but have massive amount of debt still, something like $900 million in debt, which means the enterprise value is $1 billion. And this just shows you the importance to look at market cap and compare it to enterprise value, because if you just look at market cap, you will be ignoring the amount of debt a company has. And this is the main reason I'll be staying long clear of this company until they can show signs that they are able to handle that amount of debt. So that's all I've got in this video. Are these ASX dog stocks worth a second chance or third chance, fourth chance, fifth chance? Perhaps, in my opinion, only company I might be interested in buying in the future would be AGL if they do turn the business around. They are experiencing a lot of headwinds right now, but eventually in the future they will start to see some tailwinds come behind them, and I'm pretty sure the share price will increase at some point. The question right now is how low can that share price go? Fairly negative on the other two businesses, AMP and Boart Longyear, and more than likely things will have to turn around significantly for both businesses for me to be interested in. Now that's all for this video, and I am not a financial advisor, neither are my dogs. So if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.